Welcome to my personal finance series, where every week I share my portfolio and all of my investments with you. My name's Justin, I'm 26 years old, I've been investing for 8 years now, trading options for 4, and I think we're coming up on a once-in-a-generation investment opportunity. Every Monday and Friday, tune in to see my options plays and how I plan to hit well over $1 million before 2030. If you like this kind of content, hit that like button to help this channel out. Now let's get started with today's video. Hello everyone, this is episode 2 of the weekly personal finance series. My name's Justin. Today is May 10th, and I wanted to start today off with this video. So this video is by a channel called Solving the Money Problem. This guy, his name is Stephen Mark Ryan. He basically covers a lot of Tesla content, but also not just Tesla. He covers AI and robotics and things that typically have some kind of connection to Tesla, but not entirely. And he released this video earlier today about an article written by, I guess, some company called Rethink X that talks about the impact of humanoid robots. So in the intro, I say how we're on this cusp of this AI revolution, and I think I struggle to articulate exactly like what that means sometimes. And this video, even though it's 54 minutes long, does a very, very good job at explaining the impact that AI and robotics will have on society. It's so much bigger than people realize, and I feel like it's something that not enough people talk about. For example, like we have an election cycle this year, and I would imagine in a functioning society that this would be like one of the main things that we're talking about, considering it's going to impact a lot of people in the next 5 to 10 years, but that's not happening. So either way, I think it's important to be educated on this. I'm not going to play the video. It's pretty long. It's 54 minutes, but I highly recommend watching it. And basically it just goes about talking how humanoid robots are coming, whether we like it or not. If America doesn't develop them, China will, somebody will. And, eventually, humans will be no longer needed in the workforce. If you think about how much a person costs per day, usually anywhere between $20 to $50 an hour, you're talking $100,000 salaries. And the long story short is that once you have humanoid robots that have general intelligence or any kind of intelligence that can even start with just basic tasks and evolve into more advanced tasks, the economic productivity by a human being is almost irrelevant, actually. So once again, anyway, it's a really good video. I don't want to spend too long talking about it, and I probably can't even do it justice when I'm just spitballing. I'd have to like think of what to say. So we'll move on to the rest of the stuff. So when it comes to my investing journey, so I don't think I mentioned this last week. This is called a Fear and Greed Index by CNN. And as far as I'm aware, it's a pretty objective indication on how the market is feeling at any given time. So I'm probably going to open up a lot of videos with this website just to kind of show where the market is. And the past month, it's been a little bit fearful because of, I guess, just a variety of factors. Some like job data came out and inflation and just whatever. So it was a bit fearful. It looks like we're kind of gravitating slowly back up. So you can even see there's this tab for timeline, and you can see that just about 3 weeks ago, we were on fearful at 32 out of 100, and now we're at 48. Basically, the number is 0 is super fearful and 100 is super greedy. The reason why this is useful is because if you're looking at the stock market and trying to find when is a good time to buy, if you're buying stocks, you should just buy stocks by dollar cost averaging. But if you're buying options, you might want to look at this to make sure that you're not buying when things are getting ready to change direction, because then you could just end up screwing yourself and losing all your money. And the reason why that's important too is because if you remember last time we shared this screen, I think I was at 38,000. Now we're at 27,000. So once again, like I said, if you're new to options and if you can't stomach this kind of volatility, don't do this. But because I've been doing this for a while, I don't necessarily like losing money, obviously, but it's just how it is. It's part of the game. Also, none of this is realized. I haven't realized any profits. I haven't realized any losses. So I have the same exact positions. I have not opened anything new. Something else I did not mention last time is that I have 50 shares of Tesla in this account as well. I have a strategy where basically I have cash or cash equivalents in the form of just cash or stock. And even though stock is volatile, and it's far more volatile than most places would consider what a cash equivalent is, for this strategy, I like to buy stock when I don't want to buy options, just because if things do go up, I still get a piece of the pie. But if things do go down, I don't lose as much as I would if it was in options. So it's kind of like riding the wave without being fully invested. So I do have a decent chunk of change just in Tesla shares for now. And I came up with this idea of how aggressive I am at any given time. And I wanted to share that with you. So this is the expected value calculator that I briefly mentioned last week, or actually on Monday. And I added a new tab called the sendometer or the sendometer, which is basically how hard you're sending it at any given time. And the idea is like, this is how aggressive you're playing the market. So if you're at 0%, you're not even playing, you're just sitting on the sidelines. And if you're at 100%, you are fully maxed out, leveraged to the teeth, kind of like with every spare cent involved or invested in your strategy. I don't recommend ever going to 100. I've never been at 100. The highest I've ever been maybe was like 75. But so right now I'm at like 50 or 55. So I just made 20 cells here and I just color red however many I have. So I'm going to keep track of this every week, I think. And just kind of to remember, like, for my own personal benefit, like just how aggressive I'm feeling at any given time. So May 10th, 2024, we're 55%. One quick thing too, if we look at the Tesla stock chart, so I just want to show something real quick. So we're at a pretty decent downtrend right now, which is okay. I'm not necessarily concerned. I think we're coming up on several catalysts in the next year or two when it comes to autonomous driving and potentially even humanoid robots, like that video that I said at the beginning. And the reason why this is interesting is because there's a technical pattern called a falling wedge pattern. I don't love looking at these patterns too closely because I think you'll just get lost in the sauce and think too highly of it. But if you do have a catalyst, like a real world catalyst that also aligns or correlates with the technical analysis, it does look like we're coming across a wedge pattern here. So in this picture, you can see it kind of bounces up, down, and starts to fall into a smaller and smaller trap. And eventually it'll break up. We're looking at the exact same thing. So minus this enormous correction in that 2022 inflation crash, I guess if you want to call it that, we've been zigzagging on a downward wedge channel, looking to probably break sometime around here, August 2025. So I might be really early. You know, this series might be a year early, to be honest, but we'll just keep doing it. And I just want to document my experience throughout this whole process because it's not, I want to document the parts where it sucks because that means it's not always smooth sailing. I think sometimes people are too easy or too eager to just share their highlights and they don't share their lowlights. And most of the time, what goes on behind the scenes is when it's not going well. And that's what creates success in the long run. So I think we're looking at a falling wedge pattern here, and we're possibly going to break up sometime. I mean, hopefully sooner, obviously. Maybe this wedge pattern is already over, coming close to an end. I don't think so, actually. But we'll see. So that's why I'm not buying more options, and that's why my aggressivometer or my sendometer, whatever you want to call it, is only at 55%. If we get a pretty big Tesla crash again, like sometime around the election, November 2024, I'll probably raise this bar and I'll start moving some of these shares into options again. So the last thing I want to say for this video, so this is my expected value calculator. So I did briefly show this last week, and I'll go into a little bit more detail today because I think the longer I put this off, the less this strategy makes sense. So I studied a little bit of statistics in college, and one of the ideas with probability and statistics is Monte Carlo simulation and stochastic modeling. So basically, without sounding overly complicated, if you want to predict something about the future, you can create a model to predict what you think will happen. And because nothing is certain, you can assign probabilities to each outcome. And so on this Excel spreadsheet, it's really nothing fancy. Maybe one day I can turn this into some sort of like app, but for now it's just this Excel spreadsheet. So I have Tesla stock price here, SPY here, just for reference. And then I have 5 different outcomes. So in my Monte Carlo simulation, I have time equals 2 years. So this is a 2-year window that we're looking at into the future. So we have very bearish, neutral, bullish, and very bullish. These are my 5 outcomes. And I've assigned somewhat arbitrary probabilities to these. So when it comes to creating your own predictions about the future, first of all, nobody will ever know. You're not any worse than the biggest expert anywhere, because at the end of the day, nobody really knows. So the best you can do is, assuming you've been looking at stuff that gives you some kind of context into what you're trying to predict for at least a few years, you can come up with some probabilities that you think are likely. And so in the next 2 years, I think the chances of a very bearish scenario, which would be a black swan event, kind of like COVID in 2020, is very low. But I actually think a bearish quote unquote recession in the next 2 years is actually fairly high, at least in terms of like plurality. That's the highest outcome of individual outcomes. But then as far as neutral, bullish, and very bullish, and this is specific for Tesla stock, I have the sum of these three outcomes outweigh these two. So the likelihood of me being, or at least of Tesla not going down from this moment forward for the next 2 years, or at least from 2 years from now, is 60%. What you do after that is you use this Monte Carlo simulation to create an expected value formula or calculation. So with each outcome, or each probability for each outcome, you assign a price for what you think the stock will be at that point if that outcome happens. So in the event of a very bearish scenario, I gave Tesla $40 stock price, which would be horrible considering we're at 169, so that'd be a 75% drop. Just bearish would be 80, which would be lower than it's been in the last 4.5 years, so that would be pretty bad. Neutral would be exactly where we are today. Bullish would be 400, which would basically be back to where our all-time highs are. So that's not even something that's like out of reasoning or out of realistic possibilities, because that's already happened. Very bullish would be the event that the robotaxis finally start running before the end of, what would it be, May 2026. And I think that's actually, personally, I think that's going to happen, but I try to limit my bias. So I say that's only going to be a 20% chance of happening. So in the event that I only own stock, I have my expected value of just the stock price in 2 years. And I say this, if all of these outcomes are turned into an expected value formula, which you can see here, which is the sum of the probability times the outcome price, then you take all of these price outcomes times these probabilities, take the sum, or the sum product, and then this is your expected value in 2 years. So even if that's the case, that's pretty high. I think almost doubling your stock in 2 years is very good. Once again, because this strategy is for the super aggressive, I don't want to wait forever kind of thing. So I'm trying to maximize the bang for my buck. So I'm using options instead. So here in this column E, I have my expected value for the return on investment for options. And here you can see that in the event that bearish, very bearish, bearish, or neutral probability scenario happens, I lose everything. But in the event of a bullish or very bullish scenario, I make either 600% or 3,000%. So what I do is I take the sum product of the ROI of my option strategies times these probabilities to create my expected value ROI. And this is the most important part. This is kind of arbitrary, but I tried to limit my bias as much as possible. So I created an is viable formula, which basically says if the expected value that you calculate from your options plays after doing this Monte Carlo simulation expected value formula, if you take that number, you divide it by 2, and if it's still greater than 300%, so in this case, it's 720 divided by 2, which would be 360. If that's still greater than 300, which in this case it is, then is viable equals yes. If it's not, then you're likely kidding yourself, and maybe this isn't the best time to be doing this strategy, because the most important thing about any of this whole entire stock market thing is limiting your own bias. And so obviously I have a strong bias to think about what's going to happen, but to kill that bias as much as possible, I take my options EV ROI, divide it by 2, and I still have to make sure it's greater than 300%. So this is like a minimum threshold to make sure that I'm not going to do something stupid. So this is like the most important thing. So if you wanted to do this on your own, I would recommend using options. But if you want to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. So if you wanted to do this on your own, then you can use this formula. which I don't know who will. But even if you do, I think this is probably the single most important thing that you'll have to do to make sure that you're limiting your own bias. And then I lastly have a scenario where my initial investment is $20,000, and you can see the outcomes if I bought stock versus just options. And so in this case, actually only about $10,000 of my capital is in stock or in options, I think. Oh no, it's actually 17,000. Okay, so let's say I put in about 14,800 into options right now. I have another 8,000 in stock, and then I have another like 1,000 in cash. I do have Robinhood Gold, which enables margin, and I can always deposit more cash into this account if needed. So because my sendometer is at 55%, I don't want to go too high anymore. I'm already pretty high. And in the event that the bear scenario does happen, I get blown up and I lose everything. So I don't want to be too aggressive. The whole point of this strategy is to ride the wave with leverage. And you have to almost prevent yourself from getting too excited and putting it all in at once. But so anyway, despite that, the initial investment of 20,000, I just made a compare and contrast kind of table here for if I only bought stock with that $20,000 versus if I bought options. And you can see clearly if I am wrong, I lose everything. And here would be the stock value equivalent. But if I'm right, you can see the difference here. So in the event that P bullish happens and I'm right with my options plays, I get a 600% ROI and I'm at 120,000 versus stock of 47. In the event of P very bullish, which honestly I think will happen, even though I only gave it a 20% chance, I have a 600,000 account balance versus 94,000. So that's like high level. This is kind of a super crash course version of the how to trade options video that I'll go into a little bit more refined detail on exactly how this strategy works. And lastly, I do have a T equals 5 scenario as well, where I just attribute various probabilities to a 5-year timeline. I think P bullish or very bullish is extremely likely with Tesla. Obviously, I'm biased once again, but in the event that you're just owning stock at T equals 5, you can see that your expected value would be 828 in at least my prediction. The thing is, options usually don't go out that far, and the longer you go out for options, you lose a lot of value when it comes to the amount you're paying for theta, which if you're not familiar, just disregard that. So this strategy here, in the event that I'm wrong, there is some opportunity cost of not losing that much money, but I would have to be wrong many times over in order for it to not be worth it over the course of several years. So the last thing I'm going to end this video with is the idea of opportunity costs and why this strategy might be better than just stock. So in the event that I'm wrong, I have a 40% chance of being right and 60% chance of being wrong. If I'm wrong, I do it again in T equals 2. So I would have to continue doing this over and over and continue to be wrong over and over for the stock to overlap or to basically outweigh the benefits. I said that kind of confusingly, but I have, let's call it like 4 bullets in the chamber where every bullet is 2 years. And so after maybe, let's say 8 years, if I'm still wrong with options, I keep losing money. At that point, buying stock would have been much better. But in the event that I'm right only one of those 4 bullets over the next 8 years, this upside of like, for example, 120 to 600,000, and that would be just like one of those bullets. And then I can build off of that in the next cycle and then in the next cycle, maybe not with all of it. The idea is that you just have to kind of balance between what's your opportunity cost of just buying stock like a normal person versus this strategy. If your bullets are T equals 2 years and you have 4 of them, that's not too bad. If you eventually start going down after T equals 2 and 4 bullets and you're still wrong, this isn't for you. You suck. So I think the likelihood of me being wrong 8 years in a row is pretty low. And if I am wrong 8 years in a row, then it is what it is, and maybe I'll just never do this again. But so that's the rationale of why this strategy I think is worth it. I'm going to wrap this video up here. Thank you for watching. I'll talk to you next time. Bye. Feel free to subscribe to stay tuned for future video tutorials that I'll be releasing soon and to follow along with me on this journey. Follow me on YouTube, Instagram, and Twitter, or X, or visit lifewell.co for more information about investing. And as always, I'll see you next time.